Could you give me a description of a hedge fund, your definition of short selling, and give some clarity as to how these strategies manage the downside and actively seek alpha?
The main reasons why we use short selling is really as a means to hedge some market risk. The emphasis really to have some core fundamental views and then to find mechanisms which we're able to reduce some of the volatility risk associated with holding those, call it, core views. Secondly, it also allows the opportunity to find what we call alpha opportunities, where we're not trying to profit from broad trends in markets, whether stocks, bonds, FX, commodities are going up, but really about if it's moving in relation to other assets. The emphasis is again to eliminate a component of market risk or price volatility and to extract some form of alpha from it. So this fits naturally into the context of downside protection, where the relative value opportunity, which has a component of a long asset, be it an equity or a bond, combined with the short asset, an equity or bond, affords the hedge fund manager the ability to extract value on the basis of the relative performance. It's not a case of whether bonds or equities are going up or down. It's about how these two assets potentially perform in relation to each other, and really about extracting the alpha associated with that specific opportunity.
Sometimes we say the only thing that's wrong with the hedge fund is the hedge fund name itself. But the hedge fund is simply a collective investment scheme which is similar to a long-only CIS unit trust, which is afforded more tools to invest. So hedge fund managers can utilize what you call tools of modern finance. So they can use short selling, they can use leverage, they can use derivatives. So that's the only difference between a hedge fund CIS and a long-only CIS. Short selling is a fairly easy concept whereby a hedge fund manager tries to profit from a falling market or a falling share price by borrowing scrip or shares and selling those shares in the market with the hope that the price is going to come off lower. And once the price comes off lower, the hedge fund manager can go and buy the scrip back and give it back to the broker and profit from the difference.